Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and sitting in today, the governor himself, the man, the legend, Mr. Michael Becker.
Hey, Paul.
Michael, a Merry Christmas to you and your family.
Yeah, Merry Christmas.
Also sitting in, James Eng. James.
How's it going, Paul?
A Merry Christmas to you and your family.
Thank you.
So, what is going on in the Old Capital world, James, these days?
A couple things. If you haven't gotten our white paper, go on the Old Capital Podcast website and request that. And also, we've done 3 webinars just here in the last 5-6 months about Fannie, Freddie, and then also the loan process. So go on to oldcapitalpodcast.com and view those. And then also, if you want more information, you can request it there as well.
Michael, what's going on with our friends over at SPI?
I was just staying busy, done for the year, trying to rack up some stuff for the first quarter, but it was a good year. So looking forward to another one in 2019.
That's great. Good deal. In the podcast today, we have 2 friends of ours, and I've known these guys for a long period of time. In fact, you may recognize Tom Lafferty was on podcast back about 2.5 years ago or so when he bought one of his buildings. Tells a great story about him acquiring a property. And Tom picked up a partner who happens to be a very good friend of mine, Jack Langenberg. And so we're going to talk a little bit about their transaction that they acquired and are in the process of rehabbing, in the process of putting it kind of Humpty Dumpty back together again, as I would say. And so Jack Langenberg and Tom Lafferty, welcome to the podcast. Thanks for being with us. We appreciate that.
Thanks, Paul. Happy to be here.
So I'm going to turn it over to the 2 grand inquisitors, James and Michael.
So maybe, Jack, if you can give us a little bit of your background briefly, and then we'll jump over to Tom and catch up with him.
Sure. So I've spent most of my career in corporate America in a combination of operations and finance. Been chief financial operating officer of several companies. Done a lot of mergers and acquisitions. Was the head of global M&A for a Fortune 500 company. My undergrad is from Notre Dame, and my MBA is from Harvard. So got a long background in business and been interested in real estate for a while. Been investing as a passive investor in a number of deals for about 10 years.
And Tom?
So I'm currently a full-time firefighter, probably not for much longer, but also have a few other roles in multifamily. I work with Brad Sumrock as a buyer's broker. I also syndicate my own deals, and I also help people in Brad's program with coaching.
So that last deal, so this is actually episode 51 that we talked to you about, the deal that you had just bought in 2016. Give us a quick little recap on that deal.
So that would have been Regency Place. You obviously know that one well because you did the loan on it. We bought it from an older couple that had had it for 20 plus years and had pretty much just run it into the ground. Far more than we realized before we got in. We just sold that deal right before buying Oasis Springs, and we ended up doing really well with the sale, but not a lot of distributions during ownership, as in 0.
So for 2 years, it's more just heavy value add, and once you got it stabilized, you took it out to market.
Correct.
And sold it. Okay, great. So how did you 2 meet and decide on going forward on this deal?
So I was already in the process of looking at Oasis Springs, and with all my, I think as a syndicator, including a syndicator, I have about 4 jobs. So it dawned on me that I needed some help in asset management, and so I started looking around primarily within Brad's group for somebody that had some time, was smart, sharp, and was willing to get involved and help me manage this thing day to day. And Jack just gave you his background, so I obviously scored pretty big, right? Harvard grad, and he had just, I don't know if retire is the right word, but had just left a position, had a lot of time, lives near the property. And we were connected by some other people in the group, and it was just a great fit. Jack said yes.
Jack, what did you see in Tom?
Yeah, well, Tom has extensive contacts, with brokers throughout the area, and he's done a couple deals before. And since he needed some help on the asset management side, I thought that would be a great fit. We discussed roles and goals, and I think that's really important. You hear about a lot of groups partnering up, and I think we did the process right, just make sure we had the same kind of vision on things. We're both real conservative with the numbers, too. That helps.
And then this property, so tell us a little bit about Oasis Springs.
So it's 154 units in Hearst. Part of the issues on Regency Place, the other deal you asked about, was the city. That city has a huge challenge. And so we kind of knew what we were getting into on that one. But currently it was with an ownership group that had used up all their capital, and we're just really looking to get out of it pretty quickly. It had been on the market for, I don't know, probably 6 months or more. The performance took a big dip, and so the sale was not going well. It went under contract with another buyer, and I guess he was taking too long with the contract. Broker came to me, and I actually bought my first deal from this same seller. I had made an offer on it that didn't win, so they came back to me and said, if you still want it, you can have it. I actually dropped the price a little bit, and after a few days of negotiating on it, they accepted it.
Yeah, I remember this property came out, and the performance looked great, net rental. And then essentially in, I think it was like October, November, December of 17, it just took a dive, and the buyer had to back out, and it just wasn't there. And so when you guys were underwriting this deal early in 2018, I remember talking with Tom and just saying, just be very careful on your assumptions for the supplemental on this deal, because the assumed loan is already there, but the supplemental has a lot of risk. And so make sure that's baked into the price, because on a lot of these deals, there's so much riding on a T3 and T3 net rental, and the seller's already shown that he can drop the ball on that. So besides, that, once you guys got the deal under contract, tell me a little bit about the acquisition process. Do you guys remember any interesting stories during the acquisition process?
Yeah, definitely. I think one of the most challenging things we had to work out was, the city's relentlessness on making sure that their previous inspection notes and findings were implemented before they would issue a certificate of occupancy. Fortunately, Tom had negotiated that into the purchase agreement, that a certificate of occupancy was necessary for us to close. And we ended up brokering, a deal between the city, the seller, and ourselves in terms of a number of items the city wanted done, like, resurfacing the parking lot, some woodwork, some foundation and brickwork, things like that. So fortunately, Tom negotiated some money out of them as well. It helped.
Like I said, we knew going in that Hearst was not going to give on anything, and the seller really didn't want to do it, but he did not have a CO. So yeah, we insisted on getting one before we closed, and as it turned out, they did not get one. So we just went ahead and accepted it because the performance of the property was still going down, and we just wanted to get it out of their hands and into ours. So we got a credit from them for some of the items and then took over the property.
Do you guys remember any items that came up during the site inspection from the lender or appraiser? I thought that was always a fun story.
Yeah, there were a couple model units that were being used for different activities besides just showing tenants the property.
Like what? Yeah, curious. What does that mean?
I think one of the tenants' daughters was in there with her boyfriend in one of the rooms when the lender came around.
So it's like 10 a.m. We're like, that should be a pretty safe time to do, appraiser, lender walkthrough, and one of the bedroom doors on the model was locked.
For a good reason.
From the inside.
From the inside, and we saw a guy jump out the window. Huh. So it's always
that's a lender trip James just gave you. Usually when you want to do site inspections, you do it around like 9:30 or 10 a.m. because it's early enough for some people to still sleeping it off, and it's late enough for the troublemakers to be off for school. So that's a little pro tip from James there. So it's funny.
Yeah, but you can't predict everything. So, I mean, on this one, it was a little bit different because it was a loan assumption. So anything that you guys sort of learned through this process, a loan assumption versus just sort of a new debt deal?
I would say listen to your loan broker very carefully. We were banking on about a $2 million supplemental all along, even though you told us it could go up a little bit. I distinctly remember one day answering the phone, and there was no hello, how are you doing? It was just James saying, hey, your supplemental's about to go away. That's what he told me. That was a fun day. Again, the performance of the property was dropping, and I think you were trying to work with the lender on some expense underwriting, and they were being very conservative, which wasn't helping us. But in the end, we ended up with, $350,000 more than we thought? So
right. Yeah.
So very well.
So we ended up at 75% loan to cost, which is the max that you can get on a supplemental. And a couple of things that changed throughout the process. You have to remember that when you're going through a loan assumption, there's only one guy that can do it. The guy who has the first mortgage is the only Fannie Mae lender that can do the supplemental. and they're adding more debt to a property that they already lent on, and it's only been a couple years. And so they're going to be more conservative on their underwriting than, let's say, a new debt deal. And so the collections really had to come up on this deal to get the supplemental there, and we had to really work with the appraiser and the loan underwriter to get expenses where they needed to be to get that supplemental.
Yeah, you guys really came through for us there. I mean, that's why I guess when you're looking at 2018 and finding a 154 unit property in Hearst for 68 a door, there's always, the rest of the story and some of the things with the occupancy and the supplemental came to play there.
So you guys have owned the deal for about 5 months now. So after you guys acquired it, obviously, Tom, you mentioned that you bought it before the CO was issued. You mentioned that the city was all over the property and that historically a little tougher to deal with than maybe some of the other local municipalities. And that's certainly something that if you're aspiring in this business, that is definitely something to pay attention to, especially if you're doing workforce housing, is what's the reputation of the municipality, because I've had an issue like that on one of our properties in a different city. But how's operations been since you guys taken over? What's kind of the same that you expected, and what's a little bit of a surprise after you guys have owned it for a few months here?
I don't know if I would call it a surprise, but we work with Wayner Multifamily, and they have taken over properties like this before that were in similar situations, and we were kind of trying to push them on their pro forma to show a little bit higher income so we could, make the numbers really work for our investors, and they just really held fast and said, you need to plan on not a lot of income growth in year one. You're probably going to lose a lot of tenants, and sure enough, we did. Probably a little more than we expected, but I think within the first 90 days, we had lost something like 40 tenants, and 36 of those were evictions.
That's on 154 units.
154 units. So we
went down to 73% occupancy.
That's
Unfortunately, we took Wayner's counsel on the numbers. We're still right on our net operating income target when you go month to month. So you can be without all those tenants because they weren't paying.
Yeah, sure.
And rather get them out and get the capital improvement stuff going.
Is there anything that I guess could have prevented that, or is there anything that you could have done during the acquisition process to vet that out or put something in the contract so that something like that wouldn't happen? Or
I mean, we pretty much expected it. So we knew going in that the occupancy on this deal was, I think in January of 2018, it was around 65%. And then miraculously, right before we bought it, it ramped up to 90.2, I think, just over 90%. But the income didn't really grow with it. So there was clearly an issue, and we kind of expected it. So, I mean, we could have put some contingencies in the contract that they had to maintain a certain occupancy, but I've seen other people do that, and it generally doesn't work very well.
And then not only managing sort of the rent roll, but then what CapEx are you guys doing on this property?
Sure. Well, one, we're trying to rebuild some credibility with the city from that property perspective. So we agreed with them to take care of a number of items. They're also on the lenders list as well, but those include resurfacing the parking lot, rebuilding and renovating the laundry facility on site. So we have all new machines in there with card readers. We also did some woodwork on the outside, some brick work, some foundation work on a few buildings. And so the city requires dumpster enclosures, which we're installing. Those should be soon completed.
We sort of skipped over this part, but it's becoming, when you guys closed in June, it definitely was not, I would say, as hard, but definitely the equity piece on these deals when you're going out and raising money. How was that process for you guys?
It was pretty easy on this one. I mean, like Jack was saying, we're buying almost an 80s property, pitched roofs, individual washer dryer connections, individual hot water for 68 a door when people were buying far older deals for 80 plus. I mean, we've seen some deals go for well over 80,000. So I think people realized that there was clearly opportunity here. We had a great response. We didn't send it out to a lot of people, and we actually ended up having to turn some people away. So,
did you guys have to even do like a webinar or anything, or you just sort of sent it out to the?
No, I sent it out to primarily investors that I had done deals with before. I mean, just a small group to kind of test to see what kind of response we would get. And we would go to a bigger group if needed. But, and Jack brought in quite a bit of money as well.
So I've known both of you guys for a little while now, too. Not as long as Paul has, but for a while. You made Tom your first loan on your 32-unit deal in Garland. That was 6 or 7 years ago, probably.
early 2014.
Yeah. So anyway, so that's been quite a bit of growth. So maybe talk about some lessons you've learned over that time from the first deal you did to now. In particular, we just talked about raising capital. So what are some of the things that you've experienced the hard way? Maybe taking in some investors that you choose not to do going forward. Is there anything along those lines, or anything with the way you communicate with your investors that maybe some previous mistakes that you've learned from and now communicate in a different fashion going forward?
Probably the biggest thing, I self-managed that first deal. I probably would not do that again, but I don't know. I say that. I learned a ton. I really wanted to learn everything from the ground up, but it's just not necessary. I mean, I've seen so many people buy their first deal and use third-party management, and they've done incredibly well. Most of our investors have been great, but the deals have gone well. So, as long as the money's coming in, they're happy. Regency Place, which we mentioned before, it was all capital gain. So we had some pretty patient investors. There were a few that asked some good questions. I'll just leave it at that. But probably the biggest lesson with third-party management is just learning how to deal with your. I probably dealt with the on-site people a lot more than I should have, rather than the area managers and the owner of the company, and that was a big learning curve for me.
And Jack, this is your first deal as a sponsor, but you've been passive in many deals. I know you invested in a few of mine in the past. Mm-hmm. Is there anything that's been a little bit different about this experience being on the kind of, as Paul says, in the captain's chair instead of being a passenger on the airplane, to use his ever so popular airplane analogies? Is there anything different than kind of reality than what you kind of anticipated going into this role?
Yeah, well, I guess when you've got other people's money in a deal, you really want to make sure you execute on the plan, and I feel the thrill of that. One, from just trying to get the closing to be seamless, but also now in the month-to-month and day-to-day operations. I have video surveillance that shows up on my phone, and sometimes I'm checking that when my wife is giving me the stare, but I just like to keep an eye on the property and the financials. But I think that's the main thing is being responsible for other people's money and meeting their expectations.
Yeah, the level of care you take with other people's money tends to be a little bit greater than what you do with your own, because you have a lot of trust placed in you, and you need to go out and execute. And if you don't, then you're going to feel horrible about it. So I definitely get that sense.
So Jack, as you have said, you went to Notre Dame and to Harvard. So when you're sitting around the Harvard Alumni Club and you're talking to all the guys, whether they're at hedge funds or in biotech, and you happen to say, well, I'm in investment too, and they say, what are you in, Jack? Thinking it's going to be something like that. I'm in Class C apartments in the middle of Dallas, Texas. What is that like to have a conversation with all these other guys?
I don't think many of them want to get their hands dirty like that, although there are a couple of very successful people in the Harvard Club in Dallas that focus on B and C properties. So
I think that's my point, is that you don't have to have a Harvard MBA to do this business. It doesn't hurt.
You certainly don't have to. You can learn it all by watching others and being involved. As an investor, passive on Mike's deals and some others, learned a lot by paying attention to what other people are doing. And there's plenty of opportunity to educate oneself with groups like Brad's and Lifestyles.
What did you pick up from like being an investor in Mike's group? I'm going to toot Mike's horn here, but that you've carried on to your own business with Oasis Springs.
Yeah, the transparency of how the properties are doing, I think that's really important, and having a plan and communicating that. Mike I've modeled, how we do our communications after how he does his. He sends out, all the information that he gets to all investors, and it's a great way to, prevent any kind of problems like that with, perceived transparency.
How's it been with delivering problems, or the message of problems? Because obviously everyone's got a plan going in these deals, and like what Mike Tyson's quote, everyone's got a plan to get punched in the mouth, right? Then,
until they get punched in the mouth.
Yeah, and then there's always something you don't anticipate. You can do all your contingency planning you want, and then you have a plan, and it goes a little bit different than what you think is going to be. What maybe either on this deal or maybe one of your previous deals, Tom, Jack, you guys, what's kind of been different, and how has the investors reacted to the message of the plan deviating a little bit in reality?
Well, I know on Regency Place, again, it seems like everything that could go wrong on that deal did. We turned the entire rent roll probably 2 times in 2 years. I know as an investor, I would want to know if there's problems, like as soon as they happen. I don't want to hear, hey, there have been issues snowballing for 6 months. So I would just tell them right up front. I would send monthly updates and just give them all the bad news. And But, honestly, we were on track with our plan, and everybody was pretty good with it. So I think just keeping them updated, whether it's good or bad, is really the best way to do it.
What's your focus now for this property? You're 6 months in. What's sort of your target, let's say 6 months from now? And then do you guys plan on purchasing more properties like this one, similar size, or going bigger or smaller? What have you sort of learned from the acquisition of this one so far?
Yeah, so we're almost 6 months in, and we had a number of commitments to the lender and to the city in terms of CapEx projects. We'll finish most of those. We'll probably get a waiver on the parking lot just because of the weather. As you know, it's been raining a lot here in Dallas. But looking forward for the next 6 months, we've got the next round of things that we're going to be doing in terms of interiors and some outside work for when the spring comes. Give the tenants a nice environment to enjoy the outside weather.
As far as other deals, I've always wanted to go bigger than this one, but ideally 200 plus. But deals are so hard to come by that if something shows up that works and it's smaller, I'll definitely jump on it.
So let's play 20 questions with Jack here. So Jack, define a little bit about what your roles are in this partnership. I mean, you guys are like two captains. What do you do? What's Tom do?
Sure. So, Tom has, again, the extensive connections with the brokerage community. He's looking and sourcing for deals. Once he finds one, we put it in the model and we both, review and discuss it. We've looked at several since this deal closed. But my day-to-day, or what I'm primarily focused on, is interfacing directly with our regional property manager and the city, and then in some cases our on-site team. The phone rings late at night. It comes to me, not Tom.
Right.
That's how we designed it. And, we work with Wayner, our property manager. We had a sewage backup problem one night, and I got a call at 10 o'clock at night and get the regional on the phone, and within an hour she had somebody out there, and the problem was solved by the next morning. Without much inconvenience to the tenants, and the city was happy. So, those type of things, the day-to-day. Also the financials. I think I got a new round of financials in the inbox today. Be looking at those, having a couple adjustments maybe with the Wayner financial team, and then we'll be getting our newsletter out to the investors.
Paint a picture of what this property looks like, where it's located. Our podcast is heard, it's downloaded 40,000 times throughout the United States. But a lot of people don't know where Hurst, Texas is, and what type of quality the asset is, and what type of a tenant base it is. Paint a picture in someone's head about what your property looks like.
Sure. So Hurst is located between Fort Worth and Dallas. In fact, some tenants have family members that work in both areas. So it's conveniently located just off of 183 and 121, so people can get around the Metroplex pretty easily. It has a diverse tenant base. Looks like America, which is great.
Sure.
The property was built in '79, so it's got individual hot water heaters as well as ACs, and you've got the little laundry facilities on site as well. But one thing that we liked about it, it's got a Kroger on one side, a park on another, and an elementary school on another side, and then the road. So that's pretty useful for family to be able to be in an environment like that where they can send their kids to school and do their grocery shopping with maybe one vehicle.
How are you drawing new tenants to the property?
Sure. We have several programs going on right now. There's referral programs with the tenants. That's probably our favorite source.
Are you paying them to refer you?
Yes.
And how much is that?
Right now it's $150.
Okay, and they get that when?
I'd have to check with our on-site to figure out the actual payment there, but I think it's after they've paid at least a month's rent. It's not up front. Yeah,
that's good.
Yeah, we also use a referral company that helps to lead generation, at least in this current stage of where the property is, until we get it up to the occupancy that we want. Then we'll roll back to just standard.
Were you guys putting in some CapEx, and what was the money going into for the CapEx?
Sure. The CapEx is going into, one, the continuation of the rehab that the seller had started and didn't finish in terms of individual unit upgrades.
Yep.
Also, we'll be doing the parking lot. We've got some amenities that we're working on the outside, furniture for the splash zone that's there. And
what's a splash zone? Is that
splash zone is a wonderful solution to a pool. If you have a pool, fill it in and put a splash zone in, because the moms there really like it. Their kids can go, and it's just like kind of a sprinkler thing where water shoots out in different directions. It looks kind of like the pool area, but there's no deep hole that kids can drown in.
Have you seen that, Michael?
Yeah. Yeah, so it's one of the few properties in town I know of, but think of like a splash park at a city park or Wet Wild or something like that.
Yeah, I mean, it's a little bit more safe than a 6-foot pool, I would imagine.
Definitely. And, it's all set up automatically too, where the water will the shut off, and then your kids can, with their foot, push it by the sensor, and then it comes on and it sprays them. So it'll stay on for a little bit of time and then turn
Do you
off.
have a pool on the property too, or just the
Just the splash zone.
That's great.
Yeah, it's nice.
And so how many people are on the property that work for your group?
Sure. We have 2 people in the office. They're our on-site manager, and then we also have a leasing agent that helps her. And then we have 2 maintenance people full-time. But one thing about Wayner is that they have a matrixed organization where they can, send teams of people out to do a round of rehabs if we want to, go with that group as opposed to hiring outside.
Are they the ones that are responsible for the construction management on the property?
Yes.
Is that a pretty good thing for them to be responsible for it instead of you being responsible for it?
Yes, I definitely think so, because they have so many properties that they've managed and currently manage in the Metroplex. They just have a lot more extensive knowledge on, if, A happens, how to deal with it. But they also have discounts, too, from their buying power.
Yeah, they also are good in helping us not to over-improve or under-improve. They know, they've got so many properties. I think they're up to 22,000 units or something like that. So
what do you think about that, Michael, about over-improving properties?
I mean, it's C-class deal in Hearst, Texas. So at the end of the day, there's only so much of rent the marketplace can absorb. So you can make it the Taj Mahal, and they're only going to get so much in rent. So I think that's the wise to be cognizant of that, because at the end of the day, it's an affordability issue, and the median income in that area is only so much, and they can only afford so much. So I think their objective of providing the upper end of the workforce housing scale for Hearst, Texas, and clean, affordable, safe housing that have good service and attentive to the maintenance requests. I think that's a good goal to have. What do you guys see as as we move and wrap up the podcast here? I know you guys have both been pretty active, and Tom, I know you mentioned that you help other people buy apartment complexes. So what are you guys seeing for 2019? What is your guys' objectives? And then maybe if you have any impressions of what's going on in the marketplace, just not only from your perspective, but maybe some other people you interact with, Tom, specifically. What is your view of 2019 going forward?
for the most part, I think everybody's still very, very eager to buy. Prices are still high. There's still a ton of money chasing the deals, but as long as we vet them real carefully and use conservative underwriting, everyone's still pretty positive on buying. One thing that seems to be changing a little bit, and I always run this by James since he's in the financing stuff day to day, but the loans, we've seen several loans lately where the proceeds have been cut a little bit because of the rates going up or the property's performance taking a dip. So we're trying to just make sure everybody's really careful about that.
Yeah, I mean, a lot of times we'll put out a term sheet and like on your deal, we're going to app the deal at the highest number possible that we think is reasonable. But a lot of times I'll, like I told you, if it came in at 2 million, that's what you should raise to. And that's what you should run your model at. That's what you should do your webinar at. And we'll apply for the higher number because if you apply for 2 million, the lender's not going to give you 2.3. So we got to apply for that higher number, but understand sort of what risks are in that number and understand the underwriting that's taking place to get there. And so some people will give them a term sheet and they will use the highest number possible in their webinar and everything has to go perfect throughout the transaction to hit that loan amount. And then 30 days later, it comes in a little short and they're freaking out. So I think some general partners are better at that than others. And so I know, Mike, on your webinars, I mean, you typically don't underwrite the highest possible number on that you receive from the lender.
Yeah, correct. Yeah. You need a buffer, you have a margin for error, and sometimes it's more than enough, and then sometimes it's not. So it goes both ways. What do you see in the marketplace from a standpoint? I know, or maybe just anybody here, but we're seeing the marketplace today with the last 3 years, it's been hard money day one on every deal, very limited contingencies, if at any, before your money goes hard. Are we seeing any deviation or change from that in the marketplace with the transactions that we're all seeing? Has financing contingency come back in vogue? Because that kind of went away for a couple of years. Tom, James, Paul, anybody see anything different today?
I personally was in a best and final on a deal recently that it went. I think the winning bid was just over $19 million, and it had no hard money. So that was a really active broker in town. I asked him if he was seeing a change, and he said, "Absolutely, aren't you?" So I was kind of glad to hear that.
Yeah, I think with so much volatility in interest rates and loan amounts and things like that. I mean, on this deal particular that you guys bought, it was a couple months ago or 6 months ago, but with so much volatility, especially in the financials of the seller in their net rental collections, that I think I mentioned to you guys that I wouldn't have a ton of hard money going in on this deal just in case something did happen on the
I
collections.
didn't want to, but I did.
Yeah, so we had some hard money, but it wasn't a ton on this particular deal. So
Right. Well, and you were talking about the term sheets. I've seen James get beat up a lot of times on, exactly like you were saying. You'll give somebody what you think is a safe number, and we've seen people go out and shop it, and they use some crazy assumptions, and you know what? The loan comes right back where you said it was going to in the first place. So,
Paul, have you seen anything different? You probably, you don't have the most gray hairs at the table, but you've been around the block probably more times than the rest of us here at the table. What's your take on the marketplace right now? What are you seeing today versus, a year or two ago?
I think that the market itself is still pretty stable, pretty steady. I mean, I don't think all these mountains are going to continue to go to the sky. I think we're recalibrating what yields are to be back to the investors. I think people are getting more realistic in putting money into these transactions, that they don't think they're going to go 200-300% on investments these days. But if they can make 60, 70, 80%, and they're making, maybe 5 or 6 or 7% cash on cash, I think that's a more realistic thing of what people are looking for as investors in the deal. I mean, people are still want to buy a hard asset. I mean, if you go back to the tech boom that Jack is very familiar with, we saw a poof of people's equity just disappear over a period of maybe 30 days or 60 days and that. I think people still want to own a piece of America. They want to have a feel-good business, and I think multifamily is kind of a feel-good business. Jack, let me get your perspective. I mean, you're a financial guy. I mean, like we talked about sitting around the Harvard Club about getting into multifamily. Are you talking to people about still about investing in multifamily?
Absolutely. We have plenty of investors for our next deal. I mean, Tom asked me the other day, you think we can raise $5 million? It's like, I was thinking he might have needed it in a week. How long do we have? But people want to have a hard asset that also generates income.
Right.
Many of our investors, they want to see, a monthly check along the way with the distributions. And I personally got involved with 4 more deals this year since we acquired Oasis Springs.
So you put money into other people's transactions, not just your deal.
Absolutely,
Okay.
yeah. In the last 6 months. 4 more. And some will say, oh, wow, the market's so overvalued, but you really have to look at each individual deal.
Do you remember what the yield was on this deal and maybe some of the ones that you invested in? What's the expectation today in the marketplace for the pool that you guys go into? What kind of returns attract capital? What kind of returns attract the capital investor in your deal?
On ours, I think we're showing cash on cash of just barely over 8%.
Year one?
No, that's like
the
a
average.
5-year average. Yeah,
Yeah,
but
so walk it in yield. What kind of nothing on this one? Pretty much.
No, I think it's about 4 or 5% projected in year one, and we could still be above that. I could see.
So 4 to 5 and 8 on average, and that's getting capital thrown at you.
Yeah.
Yeah. And this one had, like I said, so much upside potential on it, and some of our. Like I think our expenses came back lower than we expected, and so it potentially is a little bit better than that. We're trying to be conservative in what we showed everybody.
Yeah, and on this one, since it was an assumption supplemental, they were amortizing day one, and so that 4 or 5% cash on cash was on amortizing basis versus if it was IO, it'd probably been 8 or 9.
We were competing with a lot of other deals people could invest in that had 5 and 6 years IO. I mean,
Sure.
So yeah,
But your basis was 68. They're buying a piece of crap deal for 80 something, right?
correct.
Yeah.
Exactly.
Which I like that. I like that strategy. Coming in, getting a little lower basis. You give up the upfront yield, but you have the lower cost basis. And I think that's a little bit more attractive. And then the first mortgage you get tends to be a little bit lower on interest rate than what we could replicate today.
Yeah, you could have, James, they could have gotten a brand new loan, and how much more would the sales price gone up to get a brand new loan?
At least $1 million. And so instead of 68 a door, it's
12% or something like that, higher.
Yeah. So they had the option of taking it free and clear or doing the assumption. The assumption, I think the rate is like 4.3.
Yep.
So it just 4.32. So there was nothing in the market that could lock in, 80% of your 70% of your debt at 4.32, and then putting on the supplemental, you're essentially at 75% loan to cost. So when we look at it, if the new debt can get you 80% loan to cost, a lower interest rate, 5 years of interest only, then that's the way we typically take it. But if the new debt is only at 72% loan to cost and a higher interest rate, then it typically is not worth paying that additional $1 million.
Jack, what do you know today that you didn't know 5 years ago?
I know that
in the multifamily space.
Yeah. No. Well, I definitely know that the trends in our marketplace are continuing. I mean, you look at employment, you look at people moving to Texas. That, along with the fact that this business is, it's going to be around a long time.
Any advice, Tom or Jack, just sort of for that first-time investor who's just getting started now? What advice would you give to them as they get started in multifamily investing?
I would say make sure you get educated and don't jump in without knowing what you're doing. Or even if, a lot of people say, oh, you should buy single family homes and maybe move up to a 4-plex and an 8-plex. I can't tell you how many people I've seen whose first deal was a 100 plus unit apartment, but they didn't do it without someone holding their hand. I paid for a mentor to teach me this stuff. I mean, I joined Brad Sumrock's group 6 years ago, and I still run deals by him. I mean, it seems like every deal has some sort of little curveball, and I say little, they're not little. It can be something that could, bite you for $1 million, and you're not using your own money. You're using everyone else's in our case. So I think you just have to be very careful.
Yeah, you have to surround yourself with a great team, whether it's your broker or your construction team, a property management team. There's a whole group of people that can really help you excel if you count on their advice. And we definitely have taken the advice along the way in this deal with Wayner, with you all.
Yeah, I would also say have a long-term focus. I mean, there's so many people who are, looking to save. It sounds like a lot of money, and it is, but $50,000 on something like, hey, we can save $50,000 by cutting out a broker or cutting out our mortgage broker or something. But it's just so short-sighted. There are so many things, like I said, that can turn out very badly for you. So you just need to use your team and their experience.
Great. What's the best way for people to reach out to you guys if they have any more questions about the property or future investments?
Well, they could get a hold of me, Jack Langenberg at gmail.com.
Spell that one. That's a long one.
Yeah. JackLangenberg at gmail.com. It's probably the easiest way to get me. Yeah.
So, Jack and I have been friends for a long period of time. So, in fact, he got into single family business, and then he transitioned into multifamily business.
Yeah, I'd go with Tom's advice, jump right into the multifamily.
Yeah.
The scale is there, and although I learned a lot of tenant relations and things like that with single family.
We're getting around Christmas time. Jack, do you want a 300-unit apartment building for Christmas?
In my stocking? Absolutely.
Yeah. Absolutely. So thanks for sharing your story with us. I mean, I definitely agree with Tom. You definitely need to have a mentor help you. Like we talked about a little bit before the podcast, is that when you buy a property, you go through the sales process, you do the acquisition, and you buy your property by hopefully stabilizing it. But what you don't understand on the backside, what you really do need help on, is mentoring even on management of the property itself. So after the deal closes, you can kind of count on a property management company, but you also need to know a little bit more about what's going on and how to kind of hold the property management company to task, making sure that they're doing it right and disclosing all the information to you, and you kind of have your checks and balances too. So I think mentoring on the acquisition, but also mentoring after the deal closes to protect your investment. This is a $10, $15, $20 million investment. Just don't count on a property management company to kind of know the business, and having a good mentor will definitely help you to do it. So I look forward to seeing your stocking stuffer of 300 doors, Jack and Tom. So we appreciate that. Michael Becker, always a pleasure. And again, email address for Tom?
Probably the best one is tdmultifamily@gmail.com. It's TD like Tango Delta.
Tango Delta multifamily.com?
At gmail.com.
At gmail.com. Fantastic. James, thanks for being a part of the podcast.
Thanks, Paul.
I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.